So Activision Blizzard, they beat the estimates for their earnings and revenue. They're down year over year. This company's been very interesting to look at over the course of the last year, essentially, because back in January, Microsoft announced that they wanted to pick this company up, all in cash, $69 billion, I think for like $91 a share. Very interesting acquisition and a very smart acquisition at that, because they recently just put out the latest Call of Duty late October, and it's been crushing it. It's been doing phenomenal for the series. If you've been holding on to Activision over the last year, folks, they've actually been up over the S&P 500, 10%, around 11% return, compared to the S&P 500's negative 18% return this year. So it's a fairly decent company in this realm. Obviously, this is a value investing channel, and if you're new to the channel, my name is Leo. I'm a value investor, and I like to try to find phenomenal companies at great prices. Now, is Activision one of those companies? I haven't analyzed this company in quite some time, but I'll tell you right now, folks, it's been hovering around this price for the last little while, and it is an arbitrage play. Here's the thing, folks. If you don't know what an arbitrage play is, basically, you can make money on this company because if they've already agreed to a set point where this deal would come through, let's say they're going to buy this company for $91 a share, you purchase this company for $71 a share. Now, 71 to 91, boom, that's a $20 difference. You've made money just for no fundamentals, just holding on to this company and Microsoft just buying you out. Similar to what happened with Twitter and Elon Musk, they said he was going to buy out the company for $54 a share. So if you bought at that price, or rather if you bought Twitter at a price lower than that, you're instantly given a return of whatever that difference was. So with Activision, the question everyone's asking, is this deal going to happen? Is this deal going to go through? I don't know. I felt like, you know what? If it was going to happen, they announced it back in January. I think it should just gone through already, or at least some sort of confirmation. But it seems to me that may be a 2023 indication. That may be a 2023 thing. Now, if you were analyzing Activision, let's say as a company as a whole, let's say this deal doesn't go through, what is this company really worth? Because here's the thing that what I like to look at, and with companies, as much as it is attractive to buy this arbitrage play, if I can buy a quality business and hold on to it, I want to put myself in a win-win scenario. So with this software here, we're ranking Activision a 7 out of 10. Now, what does that mean, folks? For those that are new here, this looks at the cash flow statements, the income statements, and the balance sheets of this business. And it obviously is updated pretty much every single day whenever they put out a new statement. So with Activision, they are getting 3 zeros here. They're not earning any points in these 3 categories. What are those 3 categories? One is the 5-year average PE ratio. Now, for me as an investor, I like to try to find companies that are trading at a decent PE ratio. One being, let's say, underneath 22.5. That for me is a fair multiple, and that's pretty much the rule of thumb if you go back to Benjamin Graham. Now, with Activision, it's currently at 60.57. Pretty high. That is a premium, and doesn't help that the trailing 12 months PE ratio is at 33.51. Not looking too good on that front, as well as the return on equity average is sitting at 12.11%. We want to find companies with a 15% return on equity or higher, so no points awarded there, as well as they are diluting you if you are a shareholder by 1.47% over the last 5 years. Not a huge percentage, folks, but just something to keep in mind that you're not getting the full equity of this business, because as a shareholder, you are entitled, obviously, to the cash flows. Now, if they increase the amount of shares that are outstanding, you have to share those cash flows with other investors. Not something we want to do. Sharing is not caring. So if this number stays the same at the very least, or even better yet, decreases, that's where we want to be. Now, it's not all doom and gloom. Obviously, we have 7 points to go through with Activision where they are doing phenomenal. They have a very high current ratio. That means they have a lot of assets on hand to cover those liabilities. So in case of a liquidation, in case there's something that happens that's wrong, they are able to save themselves and pull themselves out of the water. Super important, to me at least. Their EPS is also up from 250% up increase over the last 5 years. So that's also phenomenal to see. Debt to equity is low. We want to find companies that have a low debt to equity. That means they are leveraging their capital through equity within the business and not taking on debt. Especially now with these uncertain economic times, and I've been hammering this in with all my videos. Now is the time to look at debt to equity ratios. Now is the time to look at current ratios, because we want to find recession-proof companies. Activision is in a very good spot, folks, so just keep that in mind. Net income is up, free cash flow is up, revenue growth is up, as well as our return on invested capital average sitting above 10% at 11.87%. That's pretty good. That is pretty healthy. So the company is in a very healthy scenario, and they are in a very healthy position financially. So that is great to see. The only thing that's a little bit of a gripe, as we discussed, the PE ratios, they're essentially trading at a little bit of a premium, which we don't want to see. So, I mean, obviously, it's important to see that our free cash flow is gone up. So I like seeing those numerics here. Now, what is Activision worth? Well, here on this software here, there is a price analysis section, and this will find you the intrinsic value of the company using projections for up to 20 years of assumptions. So for me, I'm going to do 3 different assumptions using the historic numbers that Activision has done. So using some past performance to try to predict the future, to get a rough ballpark of what we should be paying for this company today. I'm going to fill out these boxes, folks, and we'll talk about it in just a quick second, so stand by. And guys, if you're enjoying the video so far, hit that like button and subscribe button. It means a lot to me. It means a lot to the channel. This software here that I'm using, go to leodeleo.com, start your 7-day free trial. If you love it, use a 20% off coupon called Founder. Find that in the description box below. And you'll get 20% off your subscription for life, limited time only. And folks, this software just pays for itself and allows me to analyze companies within an instant. So definitely take the time and check it out. Now, with Activision, I put in some conservative numbers here for the revenue growth. Now, that's going to give me ultimately the most margin of safety as possible. But judging their income statements, and guys, this is another thing on the software, we have 10 years of financial data. The revenue, look at it. It's creeped up quite a bit. It ping pongs a little bit back and forth, but it doesn't grow that much. So for me, I think putting a 5, 6, and 7% revenue growth over the next 10 years, more than gracious, and it's sticking within these numbers here. That's where we're going to try to want to be, folks, within these numbers here, maybe even a haircut or so. Profit margin and free cash flow margin, I believe they can hit those numbers so that they've shown over the last 10 years or so. So 20, 21, and 21.5 makes the most sense for me on the profit margin side. And free cash flow margin, same thing, 25, 25.5, and 26. Price to free cash flow and PE ratio, we want to find companies within a reasonable multiple. We don't want to pay a premium for the free cash flow nor for their earnings. So 14, 16, and 18 stays below that 22.5 that I've mentioned earlier, and across multiples of my videos. So those are my magic numbers that I like to stick to because it is a growing company. So that 18 price to free cash flow and 18 PE ratio gives them some slack. Desired return, 13%. Let's click calculate. Now this software is going to run through all of these lovely numbers. Current price is $71, and it's going to spit out what we should be paying for Activision today. Well, it's taking a little bit longer than usual, but here we go. Let's see. It's cranking out what we got. We have to see. And here it comes. $56, folks. $56, and current price is $71. That aggressive average is almost about there, $68.04. On the low side, $44. That's it's almost there. And back in 2021, you could have had it for about that $57 mark. But I think it's been inflated ever since. Look, yeah. So look, you had it in the 60s, and then afterwards, January hit. And right here, let me, if I could just zoom in. Look, they announced, oh, look, Microsoft's wanting to buy Activision. Boom, shot up to $82 a share. So here's the thing, folks. I think Activision is a pretty solid business. They make phenomenal video games, as far as I can remember. I haven't tried the new Call of Duty just yet, but I'm pretty sure it's going to be a lot of fun if I ever get a chance to play it. But right now, average calculations, $56. It's currently overvalued in my eyes. Now, if this company's price goes down with like that, like every other company has been, this might be worth picking up. One, on two different fronts. One, because you're getting a solid cash flow business. It's been pretty consistent with its cash flows. Revenue has been pretty solid as well, so you could probably bank on that. But two, obviously the arbitrage play that exists with this business. So here's what I'm talking about putting myself in a win-win scenario. If the arbitrage play goes through, that is phenomenal. You make money that way. But if you're able to get this company at a further discount, let's say people lose hope in this business or people want to sell off and people have weak hands, you have a cash flow positive business in an emerging space. Like, here's the thing, folks. Something to keep in mind. It's a $55 billion company in a growing industry. The gaming industry is larger than the film industry and music industry combined. There's so many different facets, as well as esports becomes the next possibly big thing in regards to, I guess, sports and entertainment. They're going to be there. Activision is going to be there, as well as Call of Duty, because that is a competitive game. So it only makes sense for Microsoft to pick it up. But for you as a value investor, it's important to pick up this company at a reasonable price. That's my 2 cents. So what am I going to do? I'm going to wait. I'm going to be patient and wait. And you know what? If I miss the boat and Microsoft deal goes through and the company's stock price just goes up to $91, c'est la vie. Whatever. That's I'll take the L. But there's other companies I'm looking at. But this would be a phenomenal play, but it needs to be in my wheelhouse, and I need to be, not wheelhouse, it needs to be in my price range, and I'm being disciplined on this. So folks, if you want to get your hands on the software, leodeleo.com, found the links in the description box below. Write down a company you want to see analyzed and give me your feedback of what you think about this analysis. I'd love to hear from you. I'd love to get the conversation going. And I'll see you in the next video. Thank you so much for watching.